Ever looked at a financial chart and felt like there are these phantom zones? Moments where the market moves so explosively fast it left a literal void in its wake. What if those, gaps weren't just random anomalies, but maybe crucial, deliberate clues left behind by the biggest players in the financial world? Okay, let's unpack this. Today we're diving deep into the fascinating world of fair value gaps, or FVGs. These aren't just empty spaces on a chart. They're basically windows into market inefficiencies and, maybe more importantly, a rare glimpse into institutional order flow. Our mission in this deep dive is to really understand what FVGs are, why they appear, how you can confidently spot them on a chart, and crucially, how they're strategically used by traders operating within what's known as the smart money framework. You're going to walk away with, hopefully, a genuine shortcut to understanding a core concept in advanced price action analysis, one that really transforms how you see market movements. So to kick us off, let's get right to the heart of it. What are these fair value gaps at the most basic level?
Right. So fundamentally, FVGs represent price imbalances. It's where an asset's price has moved like incredibly quickly in one direction, and it leaves behind this empty zone where very few, if any, trades actually happened.
Okay, like a missing puzzle piece on the chart.
Exactly. That's a great analogy, a missing piece.
So for someone staring at a chart, what does this look like in practice? And why is this visual so critical to this whole smart money concept?
Well, what's truly fascinating here is how visually distinct they are. They show up as this small, almost stark void between the wicks of two specific candles. But it has to be within a very precise 3-candle sequence. It's not just any
Lit
gap.
candles, okay.
Yeah, and this isn't just some random flicker, It's a direct result of strong, decisive institutional moves. We're talking big banks, hedge funds.
Market makers.
Exactly. They're injecting such massive buy or sell orders that the price literally skips over certain price levels. And that action creates this area of inefficiency, kind of like a liquidity vacuum.
A vacuum, right.
And this is precisely why it's so central to the smart money, or you might hear inner circle trade or ICT framework. FVGs aren't just technical patterns. They serve as these direct, almost undeniable windows into that institutional order flow. When the big players make these impactful moves, they leave these unique footprints.
Footprint, okay.
And here's the really powerful tendency of the market. It not always, but often comes back to rebalance or fill that void. It seeks equilibrium.
So it wants to correct itself.
In a sense, yes. It wants to trade efficiently again in that area.
Yeah.
And that makes these FVG zones incredibly high probability areas for traders, for strategically planning entries or exits, because you're anticipating that potential return to balance.
That idea of the market seeking equilibrium is really interesting. It suggests these gaps aren't just random noise, but hold a deeper meaning. So let's really dig into the why behind them. Why do these inefficiencies happen? What is it about these giant institutional moves that stops the market trading normally there?
Well, fundamentally, FVGs reflect a stark lack of opposing orders. Basically, a massive, one-sided supply or demand gap.
Okay.
Think of it like a busy highway where suddenly all the cars are going north and there's just no one coming south to balance it out.
Right. Completely one-sided.
Exactly. And this kind of significant imbalance, it doesn't happen because of, typical retail trading volume. Yeah. It's the signature of large institutions entering the market with such force that they just blast price through levels without enough counter orders to absorb their flow.
So only the big guys can really make these.
Pretty much. Only they can create significant FVGs, which means spotting one often pinpoints exactly where those huge orders were injected. Like one source puts it quite well, FVGs are sudden price changes without enough liquidity at a stable price, indicating an imbalance.
Indicating imbalance. Makes sense.
And this whole thing leads to what traders often call the magnet concept.
The magnet concept.
Yeah, the core idea, the assumption, is that price will eventually revisit this void to restore that balance, to fill the gap. Another source highlighted that price tends to fill or retest the FVG area. It's a valuable concept where many orders were injected, creating this inefficiency.
So it draws price back.
That's the idea. And practically speaking, FVGs often line up with areas where you find liquidity pools.
Liquidity pools.
Yeah.
Meaning stop losses and pending orders.
Exactly. Zones where stop losses from retail traders tend to cluster or where pending orders are waiting. Institutional players might push price into these zones deliberately, to trigger those stops or accumulate their own large positions.
Oh, well.
And this is key. they often let price come back towards that FVG. It's almost like these zones genuinely act as magnets that draw prices back to rebalance before maybe continuing their larger move.
So the FVG highlights where the market lost balance and where smart money might be waiting to get involved again.
Precisely. It shows where they initiated and potentially where they intend to re-engage.
Okay, now that we've peeled back the layers on what fair value gaps are and the powerful institutional dynamics driving them, the burning question for any trader is, how do you actually find these things on your own chart? You mentioned a specific visual signature.
Absolutely.
Can you break down the concrete steps for identifying both a bullish and a bearish FVG so we can picture it clearly?
Sure. So FVGs are identified using a very precise 3-bar pattern on candlestick charts. That's the key, the 3 bars. And the critical piece is the middle candle in this sequence. It's always a strong, high momentum candle. It's the one doing the heavy lifting, blasting through price.
The power move.
Exactly. The first and third candles, the ones on either side, they're what actually define the gap itself. Because their wicks don't fully overlap, there's space.
Okay, so how does that look for a bullish one? An uptrend gap.
Right. For a bullish FVG, which you'll typically see during an uptrend, picture 3 consecutive candles. The middle one is a strong green or buy candle, powerful upward move. The key thing, this is what creates the gap, is that the lowest point, the low or wick of the third candle is positioned above the highest point, the high or wick of the first candle.
Above the high of the first one.
Okay, yes. This leaves that empty space, the fair value gap, sitting below the third candle's low, but above the first candle's high. Think of it like jumping upstairs and completely skipping one. That empty space where the step should be, that's your FVG. It signals that rapid upward thrust.
Got it. And bearish, downtrend gap.
Conversely, for a bearish FVG, usually found in a downtrend, again, you've got 3 candles, but this time the middle one is a strong red or sell candle, aggressive downward move. Here, the highest point, the higher wick of the third candle is below the lowest point, the low or wick of the first candle.
Below the low of the first one. Okay,
right.
The inverse.
Exactly the inverse. This leaves the gap above the third candle's high, but below the first candle's low. Like a sudden plunge downwards, completely bypassing a section of price.
Okay, that's clear.
And there's a handy rule. Bullish FVG, low of bar 3 is greater than the high of bar 1. Bearish FVG, high of bar 3, is less than the low of bar 1. Visually, they just appear as these clear, empty zones. Often, charting platforms will let you shade them in as a rectangle to highlight exactly where no trades occurred.
Right, makes them easier to spot. Okay, so once you've successfully spotted these institutional footprints using that 3-candle pattern, the big question is, what do you actually do with them? How do experienced traders integrate FVGs into their strategies? What does this mean for someone looking to use this?
Right. So FVGs are primarily used as these highly strategic entry and exit zones, and also for trade confirmation, adding weight to a decision. The most common way people use them is what's called the gap fill strategy.
The gap fill?
Yeah.
Okay.
First step, obviously, use that 3-candle pattern, identify a valid FVG, and mark that zone clearly on your chart. Second, because of that market tendency to rebalance we talked about, you patiently wait. You wait for price to retrace or pull back into that FVG area. Set an alert maybe.
Patience is key then.
Definitely. Third, once price actually enters the gap zone, you look for a confirming signal to enter your trade. So for a bullish FVG, you're looking for a buy signal, maybe a specific candlestick pattern forming inside the gap. For a bearish FVG, you look for a sell signal as price comes up into the gap.
Okay, enter on confirmation.
Yes. And finally, rigorous risk management. This is crucial. You need your profit targets and your stop losses figured out before you enter. A common profit target might be the opposite end of the gap, or maybe aiming for a set reward to risk ratio, like 2 to 1.
And the stop loss, where does that go?
Strategically placed just beyond the gap's far side. So for a long trade entering a bullish SEG, your stop goes just below the lowest point of the lowest shadow of that entire FVG zone. For a short trade into a bearish FVG, it goes just above the highest point of that zone. This keeps your risk defined if the market decides not to rebalance as you expected.
Right. Manages the downside.
Exactly. Now, some traders refine their entry even further. They might look for price actions specifically at the midpoint of the FVG or wait for extra confirming candle patterns within it. And crucially, They almost always try to trade the gap in the direction of the prevailing trend.
So with the flow.
Yes, that significantly increases the probability, right? You're
Yeah.
riding the existing momentum just using the FEG pullback as your entry point.
Makes sense.
But, and this cannot be stressed enough, risk management is absolutely vital because not every single gap will fill.
Right, it's not guaranteed.
Not at all. Market conditions change, big news can hit, institutional intent might shift. So traders have to be ready to ditch a trade idea if price never comes back to the FEG, or if the market structure fundamentally changes against them.
So stop losses are non-negotiable.
Absolutely non-negotiable. And beyond just the basic gap fill, FVGs get woven into broader strategies too. Like for trend continuation, you can use FDGs that form with the trend as pullback entry points. Or for reversals, sometimes an FVG forming against the current trend might signal a potential change of character, maybe a shift in momentum, but that always needs more confirmation, like a clear break of market structure first.
Okay, so it's versatile.
Very. And its reliability really improves when you combine FVG analysis with other strong signals,
Like what?
like established support or resistance zones, or finding areas where you see those large institutional orders historically placed, people call them order blocks, or even using tools like Fibonacci retracements to line up with the FVG zone.
So layer the evidence.
Exactly. Layer the confluence. And a quick tip. Generally, FVGs on higher time frames, like your daily or 4-hour charts, tend to carry more weight. They're stronger signals than ones you see on, say, a 5-minute chart.
Higher time frames are more reliable.
Got it.
It really clicks into place when you explain the mechanics like that. So effectively, these gaps become almost like these preordained meeting points for price, showing where the market might want to revisit smart money's initial move. Let's try and bring this to life. Quick example. Imagine you're watching a stock, clearly trending up strongly. Suddenly, boom, a clear bullish FEG forms, just like you described. Price then pulls back perfectly, right into that gap you marked out. A savvy trader might think, okay, here's my chance. They enter a buy trade right there, put their stop just below the gap.
Right.
And the expectation, based on FEG theory, is that smart money might step back in, right in that rebalance zone, to push the uptrend further.
That's the classic play, yes.
Yeah. But hold on a second. If price tends to return to these gaps, why don't retail traders just, pile all their orders right in the middle of every FEG they see? What's the catch?
That's a crucial question. And it gets to the nuance, right? While the market has a tendency to rebalance, it's not a cast iron guarantee. It's not always.
Okay, tendency, not certainty.
Exactly. The catch is that these are areas of inefficiency, not absolute magnets with 100% pull. Sometimes the initial move that created the FEG is just so strong, or the market conditions are so overwhelmingly one-sided, that price never actually comes all the way back to fill the entire gap. It might just touch the edge, or fill a small part, and then take off again.
Or it could blow right through it.
Or, yeah, even worse for the gap fill idea, price might re-enter the FVG, but then just keep going, blasting right through the other side. That could signal a continuation in the opposite direction or a major shift in market sentiment.
Okay, so it's not foolproof.
Not at all. Which is why that magnet idea isn't some magical force. It's more like a high probability zone that still needs confirmation from other factors, the overall trends, the market structure, those candlestick patterns within the FEG itself. And it just underscores, again, why disciplined risk management, those stop losses, is absolutely non-negotiable.
Right. Context and confirmation are key.
Precisely. So if we connect this all back to the bigger picture, the ultimate takeaway is that fair value gaps are incredibly powerful tools, especially in that ICT and smart money trading world. They clearly highlight where price moved too fast, that's the imbalance, and more importantly, where institutional orders likely sit.
The footprint again?
The footprints. And when you use them properly, always considering the overall market structure and using tight risk control, FVGs can pinpoint really precise entry and exit zones. They really do seem to act as a natural draw for price, and they can genuinely transform how you read a chart. You start seeing potential smart money intent, not just random price wiggles.
Gives you an edge, potentially.
Yeah, it can. The real genius, I think, isn't just that price might return, but that these gaps reveal a rare calculated tell from the biggest players. It lets you anticipate where they might re-engage. You're seeing the market less as noise and more as this deliberate dance of supply and demand, often engineered by smart money.
Yeah, that's a powerful perspective.
And it really raises an important point for retail traders. How often do we actually get such a clear, high-resolution view of market imbalances? It's a rare glimpse into that institutional order flow.
But, you've said it a few times, not foolproof.
Definitely not foolproof. As we just discussed, gaps can fail. They might not fill, especially on lower time frames or during crazy news events. So it is absolutely crucial. I know I sound like a broken record, but combine them with other analysis. Understand the trend, look for those order blocks, identify liquidity zones.
Build the full picture.
Build the full picture, exactly. And always, always use stop losses. FEGs are a component of